Is the stock market overvalued right now? Is now a good time to be buying stocks? Although these questions are hard to find definitive answers for, in this video I'm going to try to do my best to answer these questions and kind of explore some of the valuation metrics around the stock market and look at whether stocks on average look to be overvalued or undervalued or about in the middle right now. I've been investing in individual stocks, mainly dividend stocks, for about 3 years now, but for many years before that, I've been investing passively in index funds, and I still hold the pretty much vast majority of my investments in index funds. So I think it's interesting to explore both sides of the equation. On one hand, if you're investing in the index, whether the market as a whole is overvalued or undervalued is really what counts. But when you're investing in individual stocks, generally what the market is doing has less an effect on your investing, and you can more so just focus on the individual businesses and evaluate them on a case-by-case basis. So my first attempt to answer the question posed at the beginning of the video is essentially that if you're investing in individual stocks, I believe there will likely always be some companies out there that are undervalued, some companies that look to be a good bargain opportunity to be buying, and then there's always going to be some companies that are outrageously priced, some that just seem way too expensive and not really worth the price at all. So when you're investing in individual stocks, I think there's normally a wide range of valuations out there, and sometimes depending on what the market is doing, that range will skew one way towards overvalued or the other way towards undervalued, or maybe even just kind of average in the middle. But when you're talking about the overall market and investing in something like a passive index fund, for example, it is a little bit more important, I think, to kind of consider whether the market is overvalued as a whole. And we're going to look at some data right now to try to answer that question better. So this is a spreadsheet I created just to kind of showcase some of the data I wanted to talk about and be able to display it in a easy way to show. So on the left here, we have a record of the S&P 500 since 1960 with some few data points here. So this right here in column D is the price throughout that time span, all the way from below $100 in 1960 to almost $4,000, above $4,000 at some points. This data goes to the end of 2022. Right now, the S&P 500 is a little bit higher, around 4,090. And then the second column E here is the earnings per share, and then this column here is the PE ratio, which is just price divided by earnings. And then this other column, in column B, I think it's kind of an interesting metric that doesn't really get talked about all that much, and that's the earnings yield. And basically, that's just the opposite of the PE ratio. So the PE ratio takes the price and divides by the earnings, while the earnings yield takes the earnings and divides by the price, and that gives you a percentage, kind of similar to the dividend yield, but it's looking, at the full earnings of the company and comparing it to the price. And I think that's just an interesting way to look at things, and to me it almost makes a little bit more sense from a practical sense, I guess, than the PE ratio. This right here is the PE ratio over time for the S&P 500 since 1960, and we can see the average is right at 16.9 over that time period, and right now the PE ratio is just a bit above that at about 17 and a half. At least that's what it was at the end of 2022, and right now it's a little bit higher, around the 20 range, I think. So I think, from the PE ratio, it looks like the market is a little bit overvalued compared to historically. And the one thing I also wanted to do was look at earnings growth rates for the market versus the actual price. So if we think about sort of a fundamental theory or philosophy of investing, that would be that you can expect that on average over long periods of time, the returns of the market in general will pretty much mirror the returns of the actual companies in the overall market. So basically what I did here is I calculated the earnings growth rate and compare that to the growth rate of the actual index price. And we can filter it out based on various years. But if we start in around 2012, which is, I would say, kind of when a lot of companies began, really recovering from the 2008 and 2009 recession, and a lot of their recovery had already taken place, and the past decade has been a decade of super fast growth in terms of stock prices, but also earnings growth has been pretty quick as well. So we can basically compare and say that earnings growth over the past 10 years has been about 8.5% on average, whereas the growth rate of the actual price of the index has been about 10.4%, which means the index has been growing almost 2 percentage points faster per year than the earnings of the underlying businesses, which indicates essentially that the price has been growing too fast compared to the earnings, and at some point the price will need to slow down relative to earnings and let those earnings catch back up essentially. And that's basically saying that the market is a little bit overvalued, which I would generally agree with. Now, you can certainly get some different results by changing up the different years. So if we go back in time a little bit more to say like 2005, then from that perspective, it starts to even out a little bit. And if we go back all the way to 1960, we can see that over time, generally earnings and the price of the index have grown at about the same rate. So sometimes it is a little bit hard to discern there because, the starting date and ending date kind of have an impact because, if the starting date was a really bad year for earnings, but good for stock prices, then, your valuations might look a little bit funky. But I think 2012, even if we try 2010, we can see the prices have still been growing a bit more quickly than the actual underlying earnings. And I think, again, that's just another indication that the market as a whole is generally overvalued. So even if the market as a whole is generally overvalued, what does that mean for us as investors? And I think ultimately this really depends on your goals and your strategies. So if you're someone who is just wanting to not really worry about the market at all and just invest regularly dollar cost average every week or month, then I think now is just a perfectly good time to be investing just like any other time. And if you are just dollar cost averaging every week or month, eventually that's going to work out in your favor. And, it's not going to be much work at all for you if you're investing in the overall index. So I think right now is, a perfectly good time to be investing. I think if you want to still invest in indexes, but be a little bit more strategic with the timings of your investment and just trying to make those buys when the market looks to be a little bit more undervalued, then I think now is still a decent time to invest. Like we looked at, the market really doesn't seem wildly overvalued right now, but it certainly does seem a little bit overvalued. And also, given the fact that we could be heading into some sort of recession, you never really know what's going to happen. So I think maybe investing a little bit less now than you might be normally if you want to be a little bit more, I guess, active and focused on valuations. I think that could be a good idea. And if you're looking at individual stocks, though, I think, now is a perfectly good time to be investing. I think there's plenty of companies, big and small, that are undervalued right now. And I think there's plenty of companies, big and small, that are overvalued as well. For example, Pepsi is a fantastic company and I really love the company, and they just gave shareholders a 10% dividend increase, which is awesome. But I think the stock price is just pretty overvalued right now, and I don't really personally think it's worth buying. Obviously, that's not investment advice, but that's my opinion of the stock, right? And something like Johnson & Johnson, a high quality company, I think they're a little bit overvalued around, maybe fair value for sure. It's not one I'm super excited about, but it is a good company that I actually have been buying some recently. And there's some other companies that I think are, pretty awesome companies as well, something like a Kroger or a Leggett & Platt. And I think those companies are pretty undervalued right now and are pretty good bargain opportunities for investors. And again, that's just my opinion, but I wanted to share that because I think there are, when you're investing in individual stocks, there's always going to be opportunities, I think, for you to find. And it's just up to you as an investor to be able to go out and search for those opportunities and find them. So like I said before, my overall answer to the questions posed at the beginning of the video is that I do think the market is a little bit overvalued. And again, that's just my opinion. But at the same time, if you are investing in individual stocks, I do think there are always going to be opportunities to find bargain prices at fantastic companies that you can buy at a discount and still get some nice returns over time. So let me know what you guys think of the overall market and where it's going to go in the future. I'm certainly no big predictor, but I certainly do think it is a little bit overvalued. That has no bearing on what I really think is going to do in the next few years. But I think, over the next 5 or 10 years, performance may be a little bit lackluster compared to the last 10 years, which is my general conclusion. But let me know also if there's any individual stocks that you think are undervalued right now that you have been looking at. I'd be really interested to hear about those. Thanks for watching, and I'll see you all in the next one.